Let's talk about bonds. Bonds are of many types. You can have uh, government bonds, and you can have municipal bonds, and you can have corporate bonds. Now, government bonds, they are the most safe because they are backed by the government of the United States of America. And so, because they are very safe, and people know that if a bond is going to pay 10% interest a year, it's definitely going to pay 10% interest a year. There is people are they want to pay a lot more for that bond so that they can get a very safe 10% interest per year or 8% interest per year, whatever the bond is promising. Now, when it comes to municipal bonds, this is like the city of Houston, float some bonds. It's still safe. It's still the city of Houston. It's not a XYZ corporation. So this is still safe. Now, when it comes to corporate bonds, you have a variety of corporate bonds. You could have bonds being given out by big corporations. You can have bonds being given out by smaller corporations which don't have too much sales per year and those kind of things. Now, the reason corporate bonds are safer than stock, that is, shares in a company, corporate shares, is because the companies have to first pay the bondholders before they can pay anything to the shareholders. So if the shareholders want profit from the company, and if the company wants to give money to the shareholders, they first have to finish up and pay up their bond obligations. If they're not paying up the bond obligations in a year, that year the shareholders also do not get any money from the corporation. So that's why corporate bonds, depending on the corporate entity we're talking about, even these bonds are safer than stock. Now, how do these bonds actually work? So, if you take a year uh, timeline and you take the price of the bond timeline, it's not going to fluctuate too much and it's not going to rise too much as well. Maybe a little bit of fluctuation, a little bit of appreciation, but not too much because this is safe. And it's only if in the economy there's a wide interest rate swing that these swings in the bond market will be a little bigger. So that's about bonds. Now let's move on to stocks. Thanks.